It might be sort of hard to comprehend what the infinite money glitch is when it comes to investing. And this is partially because as knowledgeable investors, we all know that when something seems too good to be true, it probably is. But in this video, we are going to do a deep dive into what one of the most powerful investing strategies are in several investment vehicles any everyday investors can use to take advantage of this infinite money glitch, so to speak. Now stick around, drop a like down below, and let's get right into it. So when it comes to dividend growth investing, one of the metrics that I have found to sort of be as close as possible to an infinite money glitch, meaning that money just keeps getting bigger and bigger and really starts to rain down, is the metric dividend growth rate. Now, according to Investopedia.com, dividend growth rate is an annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies and ETFs seek to increase the dividends paid to their investors on a regular basis, and we see that across the market through various investment vehicles. Now, knowing the dividend growth rate is a key input for stock or ETF valuation and is definitely not to be taken lightly. So right here is a perfect example of how to calculate dividend growth rate. Right here it says a company's dividend payments to its shareholders over the last 5 years were year 1, $1, year 2, altogether $1.05, year number 3, altogether $1.07, year number 4, $1.11, and year number 5, $1.15. So to calculate the dividend growth rate is very simple. You basically just take the new dividend amount per year divided by the previous, and in this case, $1.05 divided by $1 minus 1 equals 5%. Now, dividend growth rate, or how much stocks or ETFs pay year over year, especially when it goes up significantly, is going to impact the power of your portfolio over time, especially if you're a younger investor that's looking to reinvest a majority of your dividends from day one back into the portfolio. Because at this point, you're getting paid dividends and you're buying more stocks and more ETFs that are also paying dividends. But here's the kicker. If you pick investment vehicles that have a high, healthy dividend growth rate, all those different stocks and ETFs that you've been buying and that you hold, they're going to pay you more and more and more over time. Now, one of my favorite examples when it comes to a high, healthy dividend growth rate is the Schwab US Dividend Equity ETF, or SCHD. And right here are all the numbers. Right here are all the dividends that SCHD has paid since inception. And right over here to the right of the screen in this column, it shows you exactly the percentage change from previous year. So this right here will show you that from the previous year. In the case of SCHD, did the new quarterly dividend move up? Did it move down? Or did it move sideways? And as you can see, pretty much since inception, this ETF has been paying more and more and more year over year. For example, take December of 2020. The dividend that was paid was 29.1% more year over year, which is a massive, massive increase. Now, to be specific, this dividend paid was 60 cents, and the previous dividend paid the previous year was 46 cents per share. Now, if you only have a few shares of something, I get it. You're not really all that concerned about dividend growth at the start, but trust me, as you stack up more and more shares of different stocks and ETFs, dividend growth rate is really going to feel like the infinite money glitch. Now, this is a very important metric, especially for dividend growth investors that are looking to hold on to their investments indefinitely. Not sell off their investments during retirement, not the 4% rule, none of that, for investors like myself that are looking to build a massive war chest of dividend-paying stocks and ETFs. Or specifically for this video, a massive amount of SCHD, and use the dividends later on in life to live off of. And of course, hopefully even have extra money to live out the later half of your life exactly how you want to. Now, for the investors out there that do have that as their goal, that want to be able to hold on to an ETF indefinitely and use the dividends over time to cover all their bills and more, dividend growth rate is very, very important. So now what you're probably saying is, great, that's awesome. Dividend growth rate's a very important input, a very important metric. I get it, that's important, especially over a long time frame. You get it. But what are some investment vehicles that have historically had really, really healthy dividend growth rates? Well, for starters, I'm going to go through my favorite. This is the SCHD ETF, or the Schwab US Dividend Equity ETF, which we just went through a second ago and has had very, very impressive dividend growth year over year. For example, SCHD from 2013 to 2014, we're looking at anywhere from a 12 to 15% year over year dividend growth rate. That means that whatever you were getting paid in dividends the year before, you are now getting a 12 to 15% raise. Now, I can't speak for all of you, but that makes me very, very excited, and that really intrigues me to buy more and more shares. Now, over time, due to specific reasonings, there's going to be different amounts of annual payout growth year over year, and that's, of course, going to depend on the investment vehicle. But again, specifically in the case of the Schwab US Dividend Equity ETF, or SCHD, the dividend growth has been anywhere from around 6.5% to 10%, or even north of 17-19% year over year. Another super high quality ETF that also has a very healthy and very high dividend growth rate and has had it for a while is VIG, or the Vanguard Dividend Appreciation Index. Now, to be more specific, year over year, this ETF has had anywhere from a small negative amount increase year over year to anywhere from 14%, 18%, everything else in between. And to be more specific, when it comes to the case of VIG, we're talking on the 10-year time frame of 5.8%, 5.7% in the 5-year, and 3%, 8.35%. Now, once again, different ETFs are going to offer different things. Just because VIG, for example, might have a smaller dividend growth rate compared to a different ETF or a different stock doesn't necessarily mean that it's worse or better. But I'm telling you that dividend growth rate is one of the most important metrics, especially if you are a younger dividend growth investor that has a long time frame ahead of them, and especially if you're looking to reinvest and compound your portfolio and build a massive, massive snowball. Please pay attention to dividend growth rate. A few more solid examples for ETFs that offered good, healthy dividend growth, something like DGRO, the iShares Core Dividend Growth ETF. With DGRO, we're talking a 5.7% in the last 5-year, 5.8% in the 10-year, 8.3% in the last 3 years, and trailing 12-month, the dividend growth has been pretty healthy at 11.2%. Now, the last ETF that we're going to go through in this video specifically that does offer a super healthy, high dividend growth rate is VU, or the Vanguard S&P 500 ETF, which has a trailing 12-month dividend growth rate of 11.28%, a 3-year of 8.3%, a 5-year of 5.7%, and a 10-year of 5.88%. So across all the ETFs we went through in this video, you can sort of see that anywhere from around 5 to 10% is sort of the sweet spot, and of course, above 10% is just kind of getting crazy. But like I mentioned a second ago, when you're analyzing what you're going to buy for your portfolio, using the dividend growth input metric, whatever you want to call it, when picking which stocks or ETFs you're going to add into your portfolio can be very, very impactful, especially if you want to compound the portfolio long-term into the future. So lastly, I want to leave you guys all with this, a real visual representation of what the power of dividend growth can do. Let's say you started a $50,000 portfolio and you bought into something like the SCHD ETF that has an initial starting dividend yield of around 4%, an expected annual dividend amount increase or dividend growth rate around 8%. A 3% annual share price appreciation, and you're reinvesting all the dividends, let's just say. And lastly, you're only adding $1 per year in contributions. So basically what I'm trying to show you here is this portfolio is basically started with $50,000, and more or less you're not adding another single outside dollar. Now, because of the power of dividend growth, your yield on cost is going to be skyrocketing year over year over year, and the amount of dividends that you're going to get paid on a yearly basis are also going to continue to move up. And this is of course because of dividend reinvestment, but on top of that, because for this example, this ETF is paying investors more and more and more year over year. So much to the point where for this simple example, a $50,000 portfolio with around $2,000 per year annually paid out in dividends over say 30 years could turn into $871,000 and $146,000 per year in dividends. But now I want to hear from you guys down below in the comments. When it comes to dividend growth rate, are other important metrics you choose to pay close attention to when building out your personal long-term dividend growth portfolio? What is the #1 most important metric that you like to go off of? Drop it down below in the comments. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.